5 years ago, I started investing with just $100. Today, that initial investment has grown to over $8,400, and I didn't need thousands of dollars, a finance degree, or insider knowledge to do it. If you have $100 right now and you're wondering how to actually start investing without feeling overwhelmed or making expensive mistakes, this video is going to walk you through the exact steps I wish someone had shown me when I was starting out. By the end of this video, you'll know exactly where to open your first investment account, what to buy, and how to avoid the mistakes that cost beginners hundreds or even thousands of dollars. Here's what most people get wrong about investing. They think you need thousands of dollars to start, or they overthink it and never actually begin. The truth is, in 2026, you can start investing with as little as $1, and the platforms have made it easier than ever. But here's the problem. There are hundreds of apps, thousands of stocks, and endless advice telling you different things. Most of it is either overly complicated or flat out wrong. I'm going to give you the simplest, most effective strategy for someone starting with $100. No day trading, no crypto gambling, no complex option strategies. Just a proven method that works whether you're investing $100 today or $10,000 next year. This is the exact process I used, and I'll show you the numbers, the platforms, and the strategy step by step. Let's get into it. Step 1. Choose the right investment platform. You need a brokerage account to invest, and in 2026, the best options for beginners are Fidelity, Charles Schwab, or Robinhood. Here's why these three stand out. Fidelity and Schwab are traditional brokerages with zero commission fees on stocks and ETFs. They're rock solid, been around forever, and have great customer support. If you want a platform that's reliable and won't disappear overnight, these are your best bets. Robinhood is easier to use if you've never invested before. The interface is simple, it's designed for beginners, and you can start with fractional shares, which means you can buy a piece of expensive stocks like Amazon or Google, even if you only have $10. Here's what I recommend. If you want simplicity and a clean app, go with Robinhood. If you want long-term reliability and plan to eventually invest larger amounts, go with Fidelity or Schwab. All three are free to sign up, have no account minimums, and you can open an account in about 10 minutes. You'll need your social security number, a bank account, and a government-issued ID. Time to set up. 10 minutes, cost $0. Best for beginners, Robinhood for easiest, Fidelity for most reliable. Step 2, understand what to actually buy. This is where most beginners screw up. They think investing means picking individual stocks like Tesla or Apple and trying to time the market. That's not investing, that's gambling. Here's what works: index funds and ETFs. These are baskets of hundreds or thousands of stocks bundled together. When you buy one share of an index fund, you're buying a tiny piece of the entire stock market. The most popular and reliable option is an S&P 500 index fund. The S&P 500 tracks the 500 largest companies in the US, Apple, Microsoft, Amazon, Google, all of them. Historically, the S&P 500 has returned about 10% per year on average over the long term. Here are the best S&P 500 index funds you can buy. VOO, that's the Vanguard S and P500 ETF, SPY, the SPDR and P500 ETF, and IVV, the iShares Core S and P500 ETF. They're all basically the same. They track the same 500 companies. The fees are incredibly low, usually around 0.03% per year, which means you keep almost all of your returns. Why index funds beat individual stocks? You don't have to guess which companies will succeed. You're betting on the entire US economy, which historically grows over time. It's diversified, low risk, and proven to work. If you only remember one thing from this video, it's this. Buy an S&P 500 index fund and hold it for years. That's the strategy. Annual return, historically, around 10%. Fees, around 0.03% per year. Risk level, low to moderate for long term. Best options, VOO, SPY, IVV. Step 3, actually invest your first $100. Here's how to do it. Open your brokerage app. Let's say you went with Fidelity. You'll see a search bar. Type in VOO and it'll pull up the Vanguard S&P 500 ETF. Click buy and you'll see the current price. Let's say it's $450 per share. Don't panic if you only have $100. Most platforms now offer fractional shares, which means you can buy a fraction of a share. So if VOO costs $450 and you have $100, you're buying 0.22 shares. That's totally fine. Enter $100 in the amount field, review the order, and hit submit. Congratulations, you're now an investor. You own a piece of 500 of the biggest companies in America. Here's what happens next. Nothing. And that's the point. You're not going to check it every day. You're not going to panic when it drops 2%, and you're not going to sell it next week. You're going to let it sit and grow. One of the biggest mistakes beginners make is obsessively checking their account and panicking when they see red numbers. The stock market goes up and down every single day. Over weeks or months, it might drop 10% or 20%. Over years, it historically goes up. If you invested $100 in the S&P 500 and left it alone for 10 years based on historical averages, it would grow to about $260. If you kept adding $100 every month for 10 years, you'd have over $20,000. The key is time and consistency. Don't touch it. Let compound interest do the work. Action. Buy your first S&P 500 index fund, VOO, SPY, or IVV. Amount $100 or whatever you can afford. Strategy. Buy and hold for years, not days. Step 4. Automate your investments so you don't have to think about it. Once you've made your first $100 investment, the next step is to set up automatic contributions. This is how you actually build wealth, by consistently adding money over time. Most brokerage apps let you set up recurring investments. You can tell Fidelity or Robinhood to automatically invest $50, $100, or $200 every month into VOO. The money gets pulled from your bank account and invested without you lifting a finger. This strategy is called dollar cost averaging. Instead of trying to time the market and buy when prices are low, you invest the same amount on a regular schedule. Some months the market is up, some months it's down, but over time you average out the price and benefit from long-term growth. Here's why this works. Let's say you invest $100 per month into the S&P 500 for 20 years. Based on a 10% average annual return, you'd end up with about $76,000. You only contributed $24,000 of your own money. The other $52,000 is growth from compound interest. Set it up once and forget about it. That's the real secret to building wealth. How to do it. Open your brokerage app, find recurring investments or auto invest. Choose your index fund, VOO, SPY, or IVV. Set the amount, $50, $100, $200 per month. Pick a date, the 1st or 15th of each month. Confirm and let it run. Time commitment. 5 minutes to set up, then 0 effort. Strategy. Dollar cost averaging. Step 5. Avoid the mistakes that cost beginners thousands. Mistake number 1, trying to pick individual stocks. You're competing against algorithms, hedge funds, and people who do this for a living. The data shows that over 90% of active traders lose money or underperform the market. Stick with index funds. Mistake number 2, panic selling when the market drops. The market will drop. It always does. In 2020, it dropped 30% in a month. In 2022, it was down over 20% for the year. But if you held through those drops, you'd be up significantly today. Drops are temporary. Long-term growth is the trend. Mistake number 3, not starting because you think $100 isn't enough. The biggest cost isn't losing money, it's lost time. If you wait 5 years to start investing because you're waiting to have enough money, you miss 5 years of compound growth. Start with what you have. Mistake number 4, investing money you need in the next year or two. If you're saving for a car, a wedding, or an emergency fund, don't invest that money. The stock market is for money you won't need for at least 5 years, ideally 10 or more. Keep short-term savings in a high-yield savings account, not the stock market. Mistake number 5, paying someone to manage your money when you're just starting out. You don't need a financial advisor to buy an S&P 500 index fund, save the fees, and do it yourself. Once you have $100,000 or more, then maybe consider professional advice. Follow these rules, and you'll avoid the traps that derail most beginner investors. All right, let's recap the exact steps you need to take. Step 1, open a brokerage account. Use Fidelity, Schwab, or Robinhood. It takes 10 minutes and costs nothing. Step 2, buy an S&P 500 index fund, VOO, SPY, or IVV. Pick one and invest your first $100. Step 3, set up automatic monthly contributions. Even if it's just $50 or $100 per month, automate it and let it run. Step 4, do nothing. Don't check it every day. Don't panic when it drops. Let time and compound growth do the work. Step 5, avoid the beginner mistakes. No individual stocks, no panic selling, no waiting until you have enough money to start. If you follow this plan, you'll be ahead of 90% of people who never start investing because they overthink it or wait for the perfect time. There's no perfect time. The best time to start was 10 years ago. The second best time is today. This is the exact strategy I used to go from $100 to over $8,000. And it's the same strategy that's worked for millions of people who've built wealth through long-term consistent investing. Here's what I want you to do right now. If you have $100, open a brokerage account today. Don't wait until next week, next month, or next year. Do it today. It takes 10 minutes. If you don't have $100 right now, that's fine. Start saving $25 or $50 per week until you hit $100, then follow these steps. The important part is that you commit to starting. If you found this helpful, subscribe because I'm breaking down money strategies like this every single week. Real numbers, real strategies, no fluff. And if you want me to cover more investing topics, like how to invest in real estate, how to build a dividend income portfolio, or the best Roth IRA strategies, drop a comment and let me know. I read every single one. Thanks for watching, and I'll see you in the next one.